Hi, my name is Josh Freeman, and I'm an attorney with Freeman Level. And welcome back to our series From Idea to Exit, where we are talking about the different legal principles to help entrepreneurs structure, scale, and sell their businesses. So today we're going to talk about um, the S Corp. We've done deep dives on LLCs, on C Corps, and now we're going to go talk about the S Corp. So with the S Corp, I like to refer to it as the third wheel. If you see my previous videos, the C Corps, the OG, the original gangster, and then the LLCs, the new kid on the block, and I think the S Corp's kind of the third wheel. The S Corp in historic settings came about in between the C Corp and the LLC, and much of the LLC was in response to the limitations that the S Corp has. So it kind of got pushed to the side in this triangle of popular entity types, and there still are some uses for it, but they're just it's just so much more limited now. So going through that, I mentioned the limitations that S corps have, and so these are the requirements and the limitations in order to have a business qualify and make an S corp election with the IRS. So first off, you can only have one class of financial stocks. So what that means is you can't have any preferred shares. You can't have owners receiving, having different distributions or allocations of profits and losses and other things like you can with a partnership. And so it's very limited that way. You can also only have up to 100 owners. It needs to be, a small business. The owners need to be only individuals. And so there are a couple caveats to that. So you can have a disregarded entity own an S corp because for the IRS's purposes, a disregarded entity I'll go back. You can have a disregarded entity that is owned by an individual be an owner of an S corp because that disregarded entity owned by an individual for tax purposes is considered only the individual for IRS purposes. And there are certain types of trusts that can own interests in an S corp. And then also the other limitation is that it's only available to U.S. citizens. So if you fit in all of these, you are eligible to be an S corp. But there are some other considerations and other things that you'll want to take into account. So first, to talk about the benefits of the S corp, the reason why people get into S corps is for saving on their self-employment taxes or the FICA taxes. And so I've created this little chart here to kind of explain. So in 2020, the FICA taxes and self-employment taxes cap out at $137,700 in any given year. So above that, there's very limited savings. So what I did is I assumed that an owner of both an S corp and of an LLC taxed as a partnership made $137,700. And then with an S corp, what you can do that you can't necessarily do with a partnership is you can designate part of those total profits and earnings as a reasonable salary. So in this, you have to take into account what your role is, what you do, what similar people would be paid for the role that you play in that business. So this is only beneficial in a business where you can justify a salary for your role lower than, the higher end of the cap, or the savings just go away. So let's say, I'm a manager of of a consulting business, and other consultants in my field are, typically get paid about $70,000. So I could justify this and pay myself a W-2 wage at $70,000. Then that would leave $67,700 as a dividend for the S corp. And so at the end of the year, when I go to pay my self-employment taxes, I only have to pay self-employment tax, which is a 15.3% tax on my reasonable salary and not on this $67,000 portion. So I only pay $10,700 in self-employment tax. So that's pretty awesome compared to the partnership where you're not eligible to do a reasonable salary to reduce the self-employment tax. So you end up paying the self-employment tax on the full $137,000, meaning you pay $21,000 of that in self-employment tax in the year. So there is a savings of a little over $10,000 in this factual scenario. And when these numbers change, everything shifts and adjusts. So if this number goes down and the reasonable salary goes up, then that savings shrinks, and so there's kind of an ideal sweet spot where it works and can be used. And so that this is the reason why most people use it. Another benefit is it is pass-through gains and losses. So it has that same benefit as a partnership. So you're avoiding the double taxation problem that we talked about in our C Corp video. Then with regards to the cons, S Corps are not good entities to receive investments in. And the reason for this is a lot of times investors want to receive some sort of preferred shares as part of their investment, and that's not possible. Another one is sometimes investors invest in groups of investors or in entities that aren't eligible to own S Corps. And so if they do buy in, then it causes a technical termination, which is a problem that we're going to talk about in just a second. So they're not good entities for investment, and they're not good with owning, appreciating, or depreciating assets. So here's the thing. So with all of those requirements that we talked about for an S Corp, if you violate one of those requirements, it automatically, without you having to say anything to the IRS, technically terminates your S Corp status. And then what that means is that you go back to being taxed as a C Corp, and it automatically treats that situation as if you transferred all of your assets from an S Corp to a C Corp without any money changing hands. So the problem comes up is if you own assets, if you own real estate or software or something that changes in value, and especially when you have an asset like real estate where not only does it appreciate in value over time, but you can write off and depreciate it on your taxes, there's often large gaps between the tax basis and the value, which means you'd have to recognize gain. So let's say, for example, you have a piece of real estate, you buy it, you've depreciated it, so you have $100,000 in basis, and the fair market value today is $1 million. And on accident, you decide to sell some of your equity to a partnership. Because partnerships can't own interests in S Corps, that causes a technical termination. And, you don't realize it, you go about your business, you don't do anything, you don't file with the IRS to correct it or do anything like that. And then the IRS comes around and says, hey, wait, you're not eligible. There's a technical termination. So you have a taxable event on that real estate that has $1 million in capital gains in it. You're like, whoa, hold on. I didn't sell anything. I didn't do anything. And the IRS says, we don't care. You went from an S Corp to a C Corp. You didn't correct it. We caught you. And so you're going to have to pay us $200,000 in taxes. And so, so that's that. That's the technical termination problem. Then there's also problems of when say you're going about, you have these assets, and then you decide you want to kind of restructure your business, and you want to move your real estate into a holding company, and you want to move your operating businesses elsewhere and your intellectual property into other places. With these, that sort of restructuring, unless you have another corporate reorganization and tax exemption, would require and cause this same taxable event. And so it gets really tricky to move things out of and move things around, and a lot of expensive tax planning in order to do so. So that's one of the big problems with S Corps, is that people start them and they don't realize what kind of assets or things they should own in them, and then it causes big problems down the road when they're looking to restructure. So we covered that with the restructure stuff. With regards to restrictions on ownership, we talked about those, restrictions already. No foreign investors, no partnerships, C corps, only individuals or qualifying entities, and you can't have preferred shares or other creative, structuring of your financial equity. And so that gets pretty limiting with growing and developing businesses. So who does this type of entity makes sense for? So who's the ideal candidate? Um, so really, this makes sense and is used regularly in professional practices, consultants, and other pure service professional businesses. So ones where you don't own real estate, inventory, software, other assets like those. Ones where you're just providing a service that has no appreciable or depreciable value. Um, and so you see them with doctors, lawyers, dentists, accountants, engineers, other people like that who are essentially providing just service providers. So in these situations, it can make a lot of sense, and oftentimes you can save money on taxes in doing so without having the problems that come up. But in general, this is not using the S corp as an exception, to the other two entity types, and it needs to be something that you carefully talk through and plan with both your CPA and your counsel. A lot of times, CPAs will not understand some of the asset and restructuring issues, and sometimes attorneys won't understand the tax savings issues, and you'll get different advice. And so, one thing that's important is when you're doing this, get both your CPA and your attorney on the phone, talk through the legal issues and the financial accounting benefits, and decide if it's the right fit. But yeah, thank you for listening. I hope this is helpful. And again, my name is Josh Freeman with Freeman Level. We love working with entrepreneurs and small business owners and helping them through the entire process of their business from idea to exit. And if there's any questions, you can track me down on with this email here, or at our website. You can contact us. But thanks for taking the time, and good luck.